Okay, and once they are into the double B and the single B, they consider we call it a high yield. Okay, so it means that the client or the investor will be compensated for higher return or higher coupon for the higher credit risk they're taking. Once they go to the C range, that is where you start hearing people calling them junk. Okay, so when people refer something as a junk bond, that means they are rated in the C range. And what goes below that? D. D refers to default. So when a company that failed its obligation to make coupon payments or couldn't return your principal at maturity, you will consider a company is in a technical default. It doesn't mean that the company will file bankruptcy protection straight away in the US or here potentially a point, let's say, going through an administration or going through a liquidation. From the point of default to VA to liquidation is a very long process. So typically when a company goes into a default, the first thing they're going to do is they're going to line up all the creditors and start negotiating a credit restructuring. Say, I'm sorry, I can't pay you back this year. Would you mind grant me extension of another 2 or 3 years? And can I pay you less coupon? We want to make sure we can turn around the business because if you are the creditor, you lend money to someone who was in the distress kind of situation. You don't really want them. You still hope that they can turn things around and then pay all your money back, right? So that's why company, when they are in stress, when they go into default, they are going to go through a very long period of restructuring, renegotiation with all the creditors and stakeholders, unless they fail to do so. Then they will probably basically throw in their head, say, look, I'm done. We need to appoint external voluntary administrator, and then administrator will come in and see that whether this company or business can be saved. Then if they will try to find a buyer. If they exhaust all options, then they'll go into liquidation. Okay, so liquidation is always basically the worst case scenario. Okay, so but again, I think a normal investor, you basically look at a credit rating as probably the rule of thumb. Obviously, the higher the rating will tell you that the higher credit quality of the borrower of the issue. Okay, now as we highlighted in the beginning of the presentation, we want to talk about the bonds that are issued by banks. The reason why we want to pay particular attention to banks being or for investors that look at the bonds that are issued by banks, because in Australia we have the dual, actually more than two regulators. So we have a prudential regulator called APRA, Australian Prudential Regulation Authority. We also have a securities regulator called Aussie. Right now, most countries, for example, if you look at US, you look at Hong Kong, look at China, they have this kind of dual, kind of regulatory framework. You have one looking at the banks and deposit taking institution, and you have the securities commissions that are looking after other companies and other companies looking at securities. So in Australia, unlike Singapore, for example, Singapore only have one MS, right? So you have one regulator look after everything. So in Australia, we have APRA looking after banks, and ASIC look after the securities. What makes banks different, or what does our prudential regulator set out to do, is that they want to ensure that at all time, the bank obviously not being solvent, but they also have adequate capital reserve that to endure when things in stress. Okay, so this is after the global financial crisis that you have heard about things, people talking about Basel III framework. There used to be Basel. There was actually Basel I, Basel II, Basel 2.5, Basel 3, and now things are moving towards Basel 3.5. So all regulators, pretty much around the world, there are probably over 176 countries that actually adopt the Basel III framework, that the prudential regulator or the bank regulator must perform stress tests on banks they supervise. This is not just in Australia. Okay, everywhere you go, your US, UK, Canada, China, Dubai, Hong Kong, Singapore. So the regulator do 2 stress tests a year. And what they do is like having a mock exam, right? They come and give you a scenario. So one scenario could be, let's assume our share market fall by 50%. Can you please work out all your risk-weighted assets and how much money you're going to lose? And do you still have enough left money to be viable as a going concern? Then 6 months later, they'll return. They'll say, okay, this time around, I'm going to give you a stress test scenario. What if our property market fall by 30%? Okay, now run your numbers and tell me that if you guys are going to survive. APRA and all regulators actually do publish the stress test result to the public. So guys, everyone, I encourage everyone to actually Google and look it up. So they probably don't publish everyone. They go by name and shame type of approach. Okay, so the most recent one, this is going back to March. We haven't received the September one. It's probably going to come out towards later part of October. But March, Suncorp was named as there was some deficiency. Okay, but probably not too material. Okay, so don't worry. I'm not bad now. Suncorp. We still love Suncorp. We still sell quite a lot of their bonds. But what I meant to say is that is how regulators, especially prudential regulators, supervising our banks. And I'm sure for many of us here sitting in the room today or even online that who had worked in the bank before, in addition to the 2 stress tests that mandated by the regulator, bank will also perform another internal stress test. Okay, so actually the banks go through 3 stress tests a year. And why we wanted to mention that to you all today is in the bond market, yes, banks are a very major player in issuing bonds or raise capital from the debt market. But you also have other companies, right? Let's say in Australia, Woolly, Coles, our supermarket, NBN, in terms of infrastructure, like in terms of Aussie, AusNet, basically your power grid, your gas pipeline, all these companies are very regular bond issuer in our market. But ASIC doesn't do stress test. Our securities regulators don't go in and say, I want to stress test you. No, they rely on the financials being audited because they're all public companies, right? So being a public company, you need to release your audit result 3 months after your end of financial year. So there is a mechanism in the market to self-regulate, right? But being a deposit-taking institution, our banks are being supervised both under ASIC and APRA. So for an investor who are new to the bond space, we as your broker and advisor, we would typically, advise our clients. You can start with the bonds that are issued by banks because there is a regulator that actually do stress tests and have applied that level of scrutiny to ensure that they maintain that capital adequacy. But this doesn't happen to other non-bank or non-deposit-taking regulated banks and insurance companies. Right, so this is important that that someone's out there looking out for you to make sure the banks are well capitalized. Okay, so that's why we do spend a lot of time talking about APRA and why that makes difference. It's material and significant difference. So this page we talked about in terms of capital structure between the normal corporate on the right-hand side of the slide and also the bank. So if we start on the right-hand side of the slide, as a normal corporate, right? What we call this is basically like a claim hierarchy. You have the senior debt, and they can come in 2 forms. One we call senior secured, means that there's a collateral being nominated, or there's a pool of collateral. Or you have a senior unsecured debt, means that there's no securities that being mentioned in the loan agreement or in the prospectus, but you rank the most senior in the capital stack. And then you have a subordinated. Then you have hybrid, something like convertible bonds and preference shares, and then you go into the common equity, like the shares you buy. Okay, so and this we would call it a waterfall or the claim hierarchy is that if the company goes into liquidation, then the more senior the creditor you are first in the line to get your money back.